Founders are the living energy in any organization until the organization is large enough to have a process itself. So, in the beginning of any organization, that is what founders do. They make sure things happen. Founders must often exercise the skill of accountability. When they can't close a sale, when a potential client doesn't agree on the terms, when the employees are low in spirits, when they feel incapable, where they're inefficient, when suppliers are late, when prices fluctuate, when there's a turmoil, when money. Accountability, therefore, provides founders with a sense that the outcome of the business is a result of their actions, not of luck. And that makes founders really, really inspiring. That is the type of founder that we want to support in venture capital. Sweat equity is a way to capture part of that energy and that make it happen attitude that we spoke about. The concept relates to the portion of the company's property that is allocated to account for the founder's extra efforts to make the company viable and to grow the company. Sweat equity is subjective and it causes a lot of debate. Some people argue that sweat equity must measure results and not time. Yes, to provide a fair compensation for founders is always a sensitive issue when seeking external funding. It is not practical to assume that a founder will work for nothing if he or she does not have any other source of income, but it is not practical to assume that a founder will receive exactly the same package that he or she will receive if working for somebody else. They have to give something up. They have to measure the effort that they put into the business in another way. That way is by owning a piece of the company, by becoming a shareholder or a participant on the company. You, as a founder, are in a better position to negotiate when you can show that part of your rewards is aligned to the results of the organization. When I manage a seed capital fund, we came up with a formula that worked for us. I have found that this is a formula that could work for a lot of people as well. Typically, our salary packages for employees that had equity in the company included a monthly payment that was between 40 to 60% of a market value salary. And then they had a bonus for accomplishing milestones between 20 and 40%. The remaining 20% of their salary compared to a market salary was assigned in shares. So their goals were aligned with our goals as investors, and we didn't have to make the extra effort. If they wanted to make more money, they had to make sure that the company met their goals. And as shareholders, they would get rewarded because the shares would provide dividends or because we would sell the shares. That combination worked really well for us. So basic salary that was around half market salary, a little bit more depending on the circumstances, a bonus that would pump that up according to milestones. This is actually a very good way to reward executives, but as shareholders, as owners of the company, you need another reward, and the other reward is related to owning a piece of the company. That makes sure that all the goals are aligned in the same way. Another special consideration is the concept of vesting of shares. It is reasonable to expect that the founders would drive a business during the business hardest times, the implementation and the survival stage, and maybe the slow growth stage. But they might want to leave the firm, and they might not want to lose all of their shares, and it might not be fair with them to lose all of their shares. The way to legally manage this is allocating shares gradually. That is called vesting. So if you finish this year with these milestones as a founder, you get allocated these shares, this percentage of the company. Before you achieve those milestones and before you stay during that period, the shares belong to the company. They don't belong to the investors, they belong to the company. So the company is releasing the shares to the founders as they go along. That doesn't work for the investors. Why? Because the investors don't work in the business. The investors provide the capital for the business. If you're a founder, here are the major pitfalls that you need to be aware of. Poor planning, lack of focus, financial slack, failure to recognize opportunity, a self-employment mentality. Without the need to request capital, chances are that if you self-fund, you will not make a business plan. Many organizations and many companies are born without a business plan. Without a business plan, you don't have a strategy to refer to or to follow or to change. But the interesting thing is that a business plan is a communication document. It's not a document to be followed. It helps you think strategically and it helps you share what you want to do with others. If you're going solo, chances are that you don't need a business plan. You can just answer a set of questions, and you will see here the set of questions that you would need to answer if you're funding the company with your own money as a founder. And finally, a founder's daily work contradicts shareholders' thinking and behavior. A real company must be able to reward the shareholders for taking the risk of investing in the company, not for working in the company. You need to work on the design of the company. You don't need to get work done. You need to make sure that the work gets done by others or in another way, shape, or form. It might take some time, but in most cases, the company must be able to pay dividends after at most 5 years, and you should be able to reward yourself as the owner of the company without having to do any work except discuss the strategy of the company. That is something that founders have a very hard time doing. If you are a founder of a company and you will put your own money into the company, I suggest that you check the mini business plan guide that is right here to be able to answer these questions. You need to understand what is the company's legal structure, who owns the company, and what are the commitments of the owners. Think that in the long run, we're all dead. So somebody's going to use up your company if you don't plan that. You need to talk about the market. What is the market's need that the company is solving? What is an ideal client? An ideal client is a person, it's not an organization. There is a person making the decisions to buy from you. Categorize that person, give him or her a name. Think about what they're doing during the day, during the night. What keeps them awake? What is the problem that you're solving for them? Think about what is your go-to-market strategy. How is the company selecting, capturing, nurturing, spoiling its clients? And think about the terms of the sale. What is the price? What is the sales conditions? Did they pay you upfront? Did they pay you in little increments? How do you get that value transformed into money into your organization? Also talk about the management team. Who is responsible for these critical functions? Therefore, who's responsible for sales, for production, for administration, for managing the team? Who is responsible for that? You will be responsible for the strategy, but somebody has to execute those 4 pillars. Is there any other critical function? Do you have to protect your intellectual property? So write it down. And that leads me to the other area, the area of production. Think about what is the process that you follow to create or to deliver the products or services that you're offering to the market. How much does it cost you to make or to have access to your offer? Do you have to engage with partnerships with others? Think about who is critical outside your organization to the success of your organization. You also want to talk about finance. If you look at the other classes here, we will have a class on financial statements. But for now, think about how much income you're going to generate. And income is a function of 2 variables. the number of products that you sell and the value of the products that you sell. So if you haven't used this, try to learn how to use an Excel sheet to make this thing flow. Think about your income in years 1, 2, 3, 4, 5, at least 1 year. After that, you can think about growing exponentially. Also think about your cost. How much money will the company spend in year 1, 2, 3, and 4? And out of this money that is spent, how much is an investment and how much is cost or working capital?